Now, because of option trading and Forex and penny trading and day trading, it's become very easy to get caught up in this idea of wanting to flip my stocks very quickly. But the reality is, as an investor, the goal is not to flip. The goal is to own for the long term, years, if not decades, if not essentially forever. And if you own these good investments for a long enough period of time, assuming it's a good investment, chances are you're going to make more money. Because that's what we've seen through history. Because if you own a good investment that's working to compound their income, compound their profits, well, you have the ability to see the value of your investment grow. Now, it can be very hard to do that when everybody else around you is always talking about flipping, but the real value is in holding for the long term, not to mention the fact that when you own your investment for longer than a year, you also get tax benefits. Because when you own your investment for longer than a year, you now qualify for long-term capital gains rates. And all that means is you qualify for lower tax rates because the government is incentivizing you through lower taxes to hold your investments for the long term, because history shows us that when you own your investments for a longer period of time, you have a better chance of making your money. It's not guaranteed, but your risk goes down if you have a bigger time horizon. Mistake number 6 is you ignore fees. If you invest your money with a 401k, if you have a financial advisor, if you invest your money into an ETF or an index fund or a mutual fund, you are paying a fee, and most people have no idea of how these fees work. So let's take a look at an example. Let's assume hypothetically that you can invest $1,000 a month. You invest this money for 30 years. You can get an 11% return on your money, and you're investing your money with a financial advisor who takes a small little 1.5% fee. Well, over the course of your career, if you get this 11% return, that means your advisor is going to take about $600,000 in fees, because while your money is working to compound and grow, so are your fees, and you're going to be left with $1.8 million. Again, that's a lot of money, but you have to understand the cost that you have with these fees. This is fine for some people because now it's completely hands-off, and now you don't have to worry about it. You have a professional managing your money, assuming that they're good. Make sure you do your research. But the whole idea here is you got to understand the cost of that fee. And a lot of people don't even realize that a 1% fee or a 1.5% fee, which a lot of advisors do charge somewhere between 1 to 2%, that can cost you hundreds of thousands, if not millions of dollars, depending on how much money you're investing and how much time your money is going to be invested for. And yes, you could do it yourself. It's not for everybody. For some people, a financial advisor is 100% worth the fee, but you got to know the cost. Now, if you invest your money into a low-cost index fund or a low-cost ETF, your fees are going to be a whole lot less, and you want to understand that those fees still exist. This is called an expense ratio. That's what you want to look at. If you have a 401k, if you're investing in an ETF, in an index fund or a mutual fund, you want to look at that term expense ratio, because that is going to be your fee. So let's do these numbers with a smaller fee. Now, same scenario. Let's assume you invest in the same $1,000 a month. You do this for 30 years, you get the same 11% return. I'm going to assume that you get the same return here just for simplicity. But now you have a low-cost fund that you're paying 0.1% on. Now, you do have to do a little bit more work than here, because you have to find the fund, you have to keep investing in it, you have to make sure you don't sell it and all of that stuff. But in this situation, now you're going to be paying around $40,000 in fees over the course of your investing career, a whole lot less than this, and you're going to be left with around $2.34 million. Again, this is going to be right for some people. This is going to be right for some people. For other people, they're not going to want to do either of these. They're going to want to invest their money themselves into their own active investments. But you have to understand how fees work, because a lot of people are just blindly investing their money without a clue of how much these fees are going to cost. And if you can make a small little change on the fee, that could add up to huge dollars at the end of your investing career, just by understanding what these fees are and maybe negotiating some of these fees a little bit lower. And this brings me to mistake number 7, not knowing your strategy. There are 3 ways that you can invest your money, and I'm not talking about trading or flipping. We're talking about actually investing your money, and a lot of people don't actually know which strategy that they're following, and then they flip between one or the other. Number 1 is you can be completely hands-off. This is by giving your money to a financial advisor like we just talked about. Number 2 is about being a passive investor. This is by investing your money into funds, ETFs, mutual funds, index funds. And now it's not completely hands-off, because you got to manage these funds, but you're not actually actively making decisions on what stocks those funds should be investing in. You just keep investing, holding on to those funds. The investment style number 3 is by being an active investor. This is being a little bit more involved. The most risk for the most potential return. This is where you're actually doing the research on which stocks to invest in. You're studying where's money moving. This is what my firm does a lot of research on, is active investing. This is what we focus on. It's more risk for more potential return, but if you can beat the market slightly, that can compound to a lot more money, a lot more wealth on the back end. Again, it's not for everybody because now you have to actually keep up with companies and listen to earnings calls and read the financial statements and study what the company is doing, more risk for more potential return. But if you're able to do it, it can add up to a lot more returns on the back end. And again, I'm not talking about 50% returns or even 20% returns a year. Just 13% returns a year can add up to $1 million plus over the course of your investing career just by getting slightly better returns on your money. So the mistake that a lot of people make is they say, I am going to be a passive investor. I'm going to invest my money into the S&P 500. Now I'm telling you this example because I've seen this happen too many times. And then as soon as the markets go down, you panic, you freak out, and you sell. I know this because I have been creating content on YouTube for about a decade now.
Who is this guy and what is the minority mindset?
Happy birthday to you.
It's crazy to believe that I've been here for 10 years. But over the last 10 years, I have seen the 2020 pandemic crash, and I have seen the 2022 stock market downturn. I've seen the 2025 market turbulence in the first half of the year. And in each one of these scenarios, what I've seen happen is that people panic and then they start to sell. Even those that are passive investors, they say, I'm going to be a long-term investor. I want to invest in the S&P 500 for the long term. And then as soon as you see the markets downturn, people freak out because you feel like everything is going to collapse. And now you sell at a huge discount, and then the financially savvy come in and buy at a huge discounted price. And this is where I want you to know the strategy. If you want to be a passive investor, you have to be investing for the long term. As an active investor, you got to be willing to put in the work and invest for the long term, which brings me to the final part of this video, which is how do you actually win and not make these mistakes? And this ties in nicely with this, which is you have to know how do you actually win in each one of these strategies. If you're going to be a hands-off investor, then let your financial advisor do what they have to do and get yourself a good advisor. Understand their fees, understand their goals, and make sure that their goals are aligned with yours. And then you have to hope that you have a good advisor that's going to manage your money well, and you can study their track record and all of that too. But when it comes to being a passive investor, the way that you win is by following what I call ABB. Always be buying. So you find the funds that you want to invest in, and now you set it and forget it. That means every week, every 2 weeks, or every month, you're going to be buying. You buy when markets are up. You buy when markets are down. You buy when markets are sideways. You buy when it's a Republican in the White House. You buy when it's a Democrat in the White House. You buy when it's raining. You buy when it's snowing. And you buy when it's sunny outside. Always be buying means always be buying. And now when you have that strategy, assuming you have a good asset, this has been proven to win. But you got to be willing to go through the ups and downs and hold on to this for the long term, and it's been a winning strategy. As an active investor, the way that I like to look at this is by studying market shifts. Now, when you study these market shifts, what that means is you want to study where the money is moving. Where are opportunities shifting? Are people spending more money on this industry or that industry? For example, when the pandemic happened, everybody went out and bought a cat or a dog. Feels like that, right? Well, that's a type of shift. Why is that a shift? Because as people buy more cats or dogs, people need more cat and dog food. People need more vet care. That creates an investment opportunity because that means more money is going to be flowing into those shifts. When President Trump came into office, well, he started imposing tariffs. That is a shift because those tariffs mean the money is going to flow into different people's hands, and that also creates investment opportunities. This is the way that you need to be thinking now as an active investor. And this is where, again, when you join my investing masterclass, you'll see how we find these market shifts because it's more focused on that active investor. But the whole idea is understanding where the money is moving. That way you can invest your money not based off of what's on CNBC or Reddit or the news headlines. You're investing based off of data. You're investing based off of research to find those opportunities before they hit the headlines. And that's why it's so important for you to understand what your strategy is, and then being willing to stick to your strategy and know how you can actually win. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.